Buying a home is no small decision. It's probably the largest financial decision we ever make in our entire life. Now, if you're buying your first home, it's probably not going to be a beautiful 4-bedroom, 3-bath home like this on 5.6 acres with a private stock fishing pond in the back. But whether it's 1,000 square feet or 5,000 square feet, very few people have enough money to pay cash for their first home. Today I'm going to introduce you to 25 concepts that will help you navigate the financial world. A is for the APR, or the annual percentage rate. Now, unlike an interest rate, this percentage includes also things like application fees, the mortgage rates, any hidden costs. It's required by the Truth in Lending Act so that you can compare all of the hidden costs, the APR. B is for buy down. You pay a lump sum in advance for either some or all of the interest, usually for a sum of 1 to 3 years to get a lower interest rate. Very helpful because interest over a long period of time costs a lot of money. C is for closing disclosure. Mortgage companies are required to close this and reveal it to the customer at least 3 days before closing. It includes all of your costs for closing, interest, monthly payments, so you know exactly where you're going to be at least 3 days before closing. DTI is your total monthly debt payments divided by your gross monthly income before taxes and represented as a percentage. This is very, very important because the Federal Housing Administration guidelines recommend that your monthly mortgage payment should never exceed 31% of your monthly gross income before taxes. E is for escrow accounts. Your mortgage lender wants you to pay your insurance and your taxes and your monthly principal payment. And so he'll gather information and tell you exactly what that is, and then he'll hold the money every month in an account at no charge to you so that you just figure it out at the closing and it's all good to go. F is for FICO score. This is really, really big. This number is what you want to have really good numbers. So you have a 3-digit number and it is determines the risk that you are as a borrower. Experian, Equifax, and TransUnion are the 3 consumer bureaus that help determine this number, and it will be determined as to which program you get. The lower the risk you are, the better the programs for your mortgage rate. G, the gross income. Your gross income is the amount of money you make before taxes are taken out. This is the number that the lender wants to look at to determine how much money you are going to be able to borrow. H is home appraisal. Home appraisal is not the market value, it's the appraised value. It has to be done by a licensed state certified professional, and it's based on that number that you will pay taxes on your home. I is for interest rate. This has to do with the total cost of the loan that you'll pay every single year. It has to do with how much money did you borrow. What was the frequency that the interest is compounded? How long is the length of the loan? These things are all important and focus in on the interest rate. J is for joint credit. Now, sometimes one person doesn't have enough credit or enough gross income to get the loan, and so a joint credit is taken into account where 2 or more people have to sign. 2 or more people are on the application, and 2 or more people are fully responsible for the payback of the loan. K is for key rate. It's the amount of rate that is set by the federal government on how much it's going to cost to borrow money. There are 2 types. There are discount rates, fund rates. These rates are determined so that the lenders know how much interest they're going to have to pay to borrow money. L is for loan commitment. Everybody wants a commitment, and this is the letter that's received from the lender stating that they're going to give a temporary approval. The letter that's really important is the ready to close letter that comes from that same lender based on the fact that all things that they said were going to happen actually did. M is for mortgage insurance. Lenders require a borrower to put down usually 20%. If they cannot afford to do that, the lender requires what's called PMI, or mortgage insurance. Mortgage insurance is to guarantee protection to the lender, not the borrower. A non-occupant co-borrower is a person who is a co-signer. They don't live in the property, but they come alongside. Oftentimes, and most usually, it's for a parent that comes alongside of an adult child as they make their first home purchase, but it doesn't have to be a first home purchase. It simply means that multiple people are responsible, and they're not going to both live in the home, but they are both responsible for the payment of the mortgage. O is for origination fee. It's the part that the lender charges to set up your loan. Some lenders split the fee into two parts and some don't. Oftentimes there's a processing fee that is the cost of taking your application and gathering the necessary documentation. And then the underwriting fee is the cost to actually bring your application and documentation all the way to closing after it's been reviewed. P is for PT, P-I-T-I. It's principal, interest, taxes, and insurance. It represents the total monthly mortgage payment. It helps the borrower and the lender determine an individual's affordability. So the principal portion is the lump sum amount you borrow from the lender to buy a home, and the interest is the fee you pay for borrowing the money from the lender. The taxes are property taxes that are divided into 12 monthly installments and added to your mortgage payment. Then you have, of course, the insurance portion of PD. It stands for the homeowners and the mortgage insurance if necessary. Q is for qualified mortgage, or QM. A qualified mortgage is a type of mortgage that meets specific borrower and lender standards outlined by the Dodd-Frank regulations that came out of Washington, D.C. These mortgages are made in conjunction with an ability to repay standard that requires lenders to evaluate and ensure that the borrower will be able to repay the loan. R is for right of rescission. This is for the people who get buyer's remorse. The right of rescission gives the borrower the opportunity to cancel the loan, cancel all the line of credits until midnight of the third day after closing, excluding federal holidays and Sundays. The right of rescission applies to refinances, home equity lines of credit, and home equity loans. However, it does not apply to a new home sale. S is for servicer. That's the one that sends you the monthly statements. They gather all the information. They make sure the escrow's up to date. They take care of the loan from start to finish. Basically, they're just like the janitor of the lending account. They'll service you and you pay for it in what's called the interest rate. Title insurance guarantees that you're going to get a home clear and free of any title mars. You're not going to get it rescinded. You're not going to have any liens brought against your home. This is insurance that you pay for. You're very wise to pay for this before closing. Make sure you get a clear title, and you're buying only a clear title, not one that has previous debt against it. U is for the 1003, or the Universal Residential Loan Application. The 1003 is just a fancy way of saying that's how they file the loan application that you need for this particular program. It shows up at the beginning of the loan application and it shows up again at closing. V is for variable rate mortgage. That just means that the interest rate is not fixed. The most common variable rate mortgage is an ARM, or an adjustable rate mortgage, which typically has an initial fixed rate for usually 5 years, followed by regular adjustable rates for the remainder of the loan. W is for the W-2 form. We're kind of used to that because when we pay our taxes, most of us that work for someone else receive a W-2 form every January, and this is the amount that you earned, both your gross and your net, and some of the expenses that are on it. This is what the mortgage lender wants to use to calculate how much you can afford to pay back when you're going through the process to qualify for a home loan, your W-2. X is for X marks the spot. That just means that there's really not a financing term that has a beginning of the letter X, but I want to just say that your closing disclosure is the X on the spot that you need to get to, because this is where you're saying, okay, mortgage lender, I'm ready, and we've done our homework, and now it's time for you to give me that letter ready to close. X marks the spot. Y is for the year-end statement. The year-end statement is what you're going to need to fill out your taxes. So your lender will provide for you how much principal you paid. Did you keep all your taxes, and did you keep up to speed with your insurance? Your escrow that they held back on the E of escrow that we talked about earlier. This is where the year-end statement says, we met our goal, we held what we said we would hold, we paid it off in full, you're good to go, let your accountant do your taxes, and let's start another year. Z is for zero down payment. Zero down payment and 100% home loan financing are two absolutely interchangeable terms. There are currently two types of governmental sponsored loans that allow you to buy a home without a down payment. One is the USDA and the other is the VA loan. Each loan program has a particular set of criteria you'll need to meet to qualify. Not everyone can get one. There are also other loan options to consider when purchasing your home, such as the FHA or conventional, which offers a low down payment option. These, my friends, are the terms that will take you A to Z through mortgage financing. I hope you find them helpful. If so, would you just write a comment to me? Would you like the video? Would you please consider sharing it with your friends? This is Brent Haggerty, eXp Realty, and I would love to hear from you. Hope to see you again real soon.